Hey everyone, welcome to another dividend stock investing video. The stock market right now is quite tumultuous, but the dividend stock investing strategy continues to work in my humble opinion. Companies like Chubb have been increasing their dividend. Chubb, for example, increased their dividend by 3.75% today, despite the stock market tanking. Those investors who wish to live off of cash flow, off of their investments, often benefit from dividend stocks because when stock prices are depressed, those stocks keep paying cash flow that can be used to cover living expenses. And in the case of Chubb, these stocks are actually increasing cash flow to shareholders. And this is really key because such investors are not forced to sell the equity at depressed levels like we are seeing right now. In my humble opinion, this 3 or 4% withdrawal rule of taking equity out of the market, it just does not work in times like this to pay bills. I want to cover a few things in the video today. I want to share what is going on right now in our economy and stock market. I want to share what I see coming forward as this story unfolds over the next few months and even the next few years. Last, I want to share my personal strategy and what I am doing during these tumultuous times. Of course, I also want to share in the video today the stocks that I am personally purchasing right now. Get ready, everyone, for a really exciting dividend stock investing video. Welcome to PPC Ian. This is dividend stock investing for everyone. All right, everyone. So I want to get started today with what is happening in our economy right now. Before I get started, make sure to check out the pinned comment below where I link to my personal Patreon. Over there on Patreon, on the corner patron tier, I just uploaded my brand new stock portfolio that shows my percentage allocation to each position. I have been making a lot of trades lately. I share those trades over on Patreon on the backyard level and on the corner level. And now on the corner level, I have my brand new portfolio as well. And in the coming weeks, I'm also going to be uploading on the corner level my complete bond portfolio as well, because I have been including some fixed income in my portfolio as well. And I'll show the percentage allocation to the various bonds, and I'll show how on a percentage basis my bond portfolio compares to my stock portfolio. So check it out in the pinned comment below. Now, what is happening in our economy right now, in our stock market right now? Check it out on the screen in front of you. As you can see, the Federal Reserve increased the Fed funds rate. The Fed funds rate, it's going up. It's going up in these half a point increments, and there is no end in sight. As a result, mortgage rates and loan rates are going up. Interest rates are going up. I have been hearing anecdotally that folks purchasing homes here are seeing interest rates in the 5% range, and even some of them now coming in the low 6% range. That is quite different than the 3% range that we were seeing just last year. As a result of these interest rate increases, the cost of business is higher than ever. We're seeing the cost of business get higher for a few reasons. One is businesses refinance debt. Interest rates are higher, and so interest expense is going to be higher. But also, we live in an inflationary environment, and so margins are getting squeezed by inflationary pressures. That's the whole reason the Fed funds rate is going up. The Federal Reserve is increasing the Fed funds rate to try and squash inflation. And in my humble opinion, this inflation was caused as a result of the excessive stimulus during the pandemic era. Now, politicians simultaneously are inciting the masses to basically hate corporations and try to band together against them. This is further increasing the cost of doing business because corporations now are facing more pressure than ever before from social media and from the politicians. Now, our Fed chairman, Jay Powell, he believes there may be more pain ahead, and he is basically doing what it takes to stop inflation. In my humble opinion, Jay Powell is coming across a lot different than some of these Fed chairmen of the past. Jay Powell, in my humble opinion, based on what I've read, a lot of his education comes from Fed Chairman Volcker, who took a very aggressive stance on inflation in the past. And so Jay Powell is doing the same thing. He wants to keep inflation down. He's willing to increase the Fed funds rate. He's willing to take measures that may be a little harsh. It may not be such a soft landing. It may be a little bit more aggressive. It may tank the stock market, and he's okay with that. And that's a lot different than what we've seen in the past with Fed chairmen like Alan Greenspan and Janet Yellen, for example. Let's keep going. As you can see on the screen in front of you right now, what I also want to share is there may no longer be a Fed put. There was this concept in the past that, hey, stock market is tanking, Federal Reserve is going to ease interest rates, a Fed put of sorts, and that's going to stimulate the stock market. It seems at this time that Jay Powell really isn't interested in a Fed put, but he's just going to keep increasing interest rates. And so I don't really think there's going to be a soft landing at this point. I think inflation is out of control. We're even seeing that with I-bonds, for example. They're offering 9.62% interest rate. That gets reset every 6 months based on the CPI-U index. But we are seeing government measured inflation at 9.62%. And so you got to wonder, how bad is inflation really at when that's what the government is measuring it at? And the government is typically a little bit more conservative than consumers like you and me see in the real world. So inflation is out of control, and the Fed is doing what it can to put an end to it. This is really tricky for businesses because simultaneously interest rates are going up, but also these inflationary pressures and social pressures are also squeezing their margins. So a lot of doom and gloom. That's where we're at right now. Now, always keep in mind, I started off this video with a positive narrative about dividend investing, because dividend investing is a style of investment, in my humble opinion, that thrives in all kinds of economies, including ones like now. And quite frankly, as someone who is still building his dividend stock portfolio, I like opportunities like now when the market is going down, because the money I invest that I put into the stock market, it's purchasing equities at lower and lower prices, which gives me more and more starting yield. I'm getting more dividend income for my money invested, which gets me to financial freedom quicker. And so there's a lot of positivity that comes out of this for long-term dividend-oriented investors. But here's where I see things going, and then I'll get into my strategy. So as you can see on the screen in front of you right now, I want to talk about what's going to happen. And again, I have a little bit more doom and gloom, and I am a more conservative investor, so I'm trying to paint a realistic picture here of what will happen. And I think layoffs are going to happen. Unfortunately, companies are going to get squeezed. Margins are going to get squeezed. They're going to have to find ways to get more efficient. They're going to have to find ways to squeeze out more profit. They're going to get proactive here as we see the economy slow down. I think it's a foregone conclusion that we are going to head into a recession here. We are going to head into potentially a prolonged recession with interest rates really reversing from these historically low rates, and with no end in sight. They are going to have to go aggressive on these rates if they really want to stop inflation. And layoffs, unfortunately, will happen. It's going to be devastating and tragic, and my heart goes out to anyone affected by a layoff. I shared a video on my channel here. I'll link to it in the description below. This is a video from a while ago, but I shared my personal experience going through a layoff. It was terrible. I was laid off of a job, and that helped define myself as an investor in many ways. That's why I am such a conservative investor, because I know how difficult and challenging and demotivating and horrible it can be to face something like that. And that's one of the reasons I am a dividend investor. But check out that video if you want to learn more about my personal experience with a layoff. I'll share that in the description in the pinned comment below. But let's keep going. As you can see on the screen in front of you right now, what I also want to share is that salaries may taper off during this time, or even while there's inflation and salaries should be going up. If companies start facing enough pressure, they are going to do certain things with salaries. They may cut salaries. They may say, hey, no more increases in salaries for a while. They may say, hey, we're not doing bonuses this year. We could see some of that. And what I would say as well, and this is an interesting point, what I've seen typically during these bad times is people at work are going to fight for their job, and sometimes they can even get opportunistic. And so I want to place a warning out there to the dividend investing community that if you work a job, that job is the lifeblood of your dividend portfolio. It's also the backbone of your family's finances and your ability to pay the bills. Try to stay out of drama at work, and work may be getting a little bit more political. It may be just as political as it is in our nation's capital right now, and so it could get that way. And it's going to be important to recognize that that may be coming, and I'm going to talk about my strategy around that in a bit. But I want to foreshadow here what I see happening. And we've seen this, I've seen this in bad times before, that it gets even more political in the workplace than ever before. It can get ugly, it can get stressful, and this may last a while. So one of the other things I want to say, again, a lot of doom and gloom, but this may not be the quick spike down in recovery that we saw in 2020. That was a lot shorter than anyone thought. The reason the plunge and then the resurgence in stocks in 2020 was so strong and so swift and so quick is because of the Federal Reserve. The Federal Reserve cut rates and entered so much stimulus into our economy that things came back. And there's a lot of economists that believe the market is the Fed, or the Fed is the market. What the Fed does influences the overall stock market. And so if we see, I buy into that a little bit as well. And if we see the Fed increasing rates over the course of the next quarters and maybe even years, keeping them higher, and they're not stimulating the stock market, I don't know if this resurgence in stocks this next time will be quite as quick as it was in 2020. 2020 was such a resurgence in stocks because of the stimulus and because of how quickly the stimulus was entered into our economy during the pandemic. So I've got a lot of bad news for you today, a lot of doom and gloom, but I want to share my strategy. How do I get from point A, the beginning of this correction, to point B, the end of this correction, when things bottom out, start heading in the right direction, both from an economic standpoint and an investor's standpoint? I want to share my strategy, and then I'm going to share in a minute the stocks that I'm buying right now. So as you can see on the screen in front of you right now, this is my personal strategy as I make it through these challenging times. And again, it's not all doom and gloom. I take comfort in the fact that I own world-class dividend-paying stocks. They're going to continue to pay and even increase their dividends during bad times. I've already seen this from companies like Chubb and so many others that have recently increased their dividend. Times like these highlight the benefit of dividend stocks for those who want to live off of dividends during positive growing times. Sometimes the value of dividends is not fully appreciated. I think during corrections, it gives us all an appreciation for the comfort and the stability of dividends. Now, not all dividends are equal. I'm talking about dividends from world-class companies, the best companies in the world, like Johnson & Johnson. And so I'm not forced to sell during a rough market to live. I can use my cash flow from Johnson & Johnson, and they will likely continue to increase their dividend as they have been. And so that's the first positive point. The other thing I want to say is during difficult times, it's easy to get really focused on money and on the stock market. And so I'm going to keep myself healthy by exercising regularly and eating well. I'm going to keep myself further healthy by focusing on things other than money and work. I'm going to find hobbies. I'm going to spend time with the family. I'm going to really enjoy setting up things in our new home, all of that kind of stuff. I'm also going to keep some cash reserves for emergencies. We all know that during tumultuous times, anything can happen. And so I want to sleep well at night by making sure my reserves are strong and continue to remain strong. What I'm also going to do is I'm going to keep it cool at work. This is really, really important for all the type A players that are out there right here watching the channel. So when I say type A or an A player, I mean someone who really cares about their job, someone who does a good job, someone who wants to get promoted at work, someone that cares about the company. The challenge I've found during rough times is a lot of people are going to be fighting at a company for a smaller pool of positions, unfortunately. It can get political. And what I've also found during rough times is sometimes at work, people just don't want anything criticized. They don't want to know how to do things better. They don't want to improve, so on and so forth. This is really difficult for A players because an A player cannot rest at night without doing his or her best work. I'm like that. It really pains me when I'm at work and I see anything that is not perfect. Now, the problem is with this, sometimes it can get you into trouble if you challenge the wrong person at work, if you get into a political dispute at work. These types of things are heightened during economic volatility. These types of things can be heightened during times like this. This is not the time to get political at work. This is not the time to fight at work. This is not the time to really go out there and push for something at work. And this is really against the grain of someone who wants to do the best for the company. But what I'm saying is the most important thing as a dividend stock investor is to maintain your job, maintain the lifeblood of your portfolio, keep deploying money into the portfolio. And sometimes at work, quite frankly, it is better to actually leave and walk away from a situation where you could get in trouble. It's better just to say nothing. It's better just to kind of go with the flow, even if you don't believe that's the right strategy for the company. It's really hard. It's really sad. It's not how it should be, but I'm trying to speak to the realities, the economic realities, the political realities of working in corporate America. Now is the time to be on everyone else's side, to try to be a team player, to try to go with the flow, to try and maintain that income, because that income can be deployed into dividend stocks at the very time when they're trading at the most attractive levels. And that is what is so exciting about a correction, is it's an opportunity to go bargain shopping, but it's only possible to go bargain shopping with a steady income coming through. And certainly when that steady income evaporates, hopefully that investor has an emergency fund, but if a new job cannot be found before the emergency fund is gone, unfortunately what happens in that case is having to go in and sell stocks at depressed levels, which is the nightmare, the absolute nightmare of the dividend investor. And so everything I've done in my life is orchestrated around protecting the dividend portfolio. And part of protecting it is not only an excessive emergency fund, not only that, but it's also going forth and just having the right mentality at work, especially during times that are tumultuous. It's not times to really push against the grain, in my humble opinion. Let's keep going. As you can see on the screen right now, the next thing I want to share is work is tough, but honestly, there is a lot of positivity from it as well. It is your source of capital for dividend stock investing. And whereas at work, maybe you can't be an A player all the time because that's just not the culture. Well, you can define your own culture in your dividend stock portfolio. That's your baby. That's your company. I look at my portfolio as a company of sorts. It's a company of companies. It's my own investment fund. And that's where I can do my A player work 24/7. And so I'm going to find scrappy ways to generate more income for investing. I'm going to dollar cost average into declining stock prices with a clear focus on core stocks. If things get truly bad, I'll probably go as aggressive as I did back in 2020, which was pretty aggressive. I'm also at this time adding some stable Treasury bonds to my portfolio with the goal of holding to maturity. It's just lowering my portfolio volatility, and those yields now are up pretty high. I'll talk about an auction I participated in recently, but I was in the 20-year Treasury bond auction, and that ended up at a coupon rate of 3.25%, but actually a yield on cost a little higher because the bond went for slightly lower than face value. Whole life insurance can make sense too. I know a lot of people talk down about this. A lot of people don't like it, but for the right people, it can make sense. I actually talked about whole life insurance on my Patreon for my Corner patrons, which I'll link to in the pinned comment below if you want to sign up for Corner Patreon. That is a bond-like equivalent in many ways, which has a lot of tax advantages as well. And so that can make sense. I'm looking at ways to diversify here. I'm looking at ways to mitigate volatility in the portfolio, and the whole life insurance and Treasury bonds are two methods that I'm looking at and participating in right now. As you can see in front of you on the screen right now, my strategy just keeps going. My strategy gets pretty complex, but when the market starts rebounding, when the economy starts rebounding, it's going to be time to slow down a bit for me. I'm going to rebuild my cash buffers. I'm going to rebuild cash positions. I want to avoid lifestyle inflation, and I want to learn lessons. And what's so fun, quite frankly, I've been on YouTube a while. You all have seen my videos over the year. If you've been here for a long time, please share that in the comments below. I always love those comments. And if you enjoy the video so far, please go ahead and smash the like button. It means the world to me. Please also go ahead and subscribe with the notification bell. It really helps out my channel growing and reaching more subscribers. But what I want to share that's so exciting and interesting, and I don't mind being humble here, it's all on the table. You can see it all. I have all my videos on YouTube. You see when I've been really successful. You've seen when I've made mistakes. And one thing I noticed in going back and analyzing some of my videos from the past is so interesting is whenever I kind of deviate my strategy from core dividend stocks to something else, it's always signaling a market peak. And it kind of signals a market peak because if I'm going away from my core stocks, it means core stocks are overvalued and I'm kind of trying to find value elsewhere. And usually if I'm doing that, it means the market, the economy is overheated. And so a few years ago, there was a time where I couldn't find any value at all in core dividend stocks. And so what I did instead is I was looking for quote unquote high yield stocks. As soon as I started doing that, I bought a few high yield stocks and then the market started collapsing. Now, fast forward a little bit in more recent years, there was a time recently where I was going after more high growth. I'm like, hey, I built my core, I built my base. I want to branch out and do some high growth stocks, a little bit of high growth in the portfolio. As soon as I started doing that, it kind of led up to where we are now. And so basically the lessons I've learned by going back and analyzing my videos and my investing, and you can do the same if you keep an investing journal or any kind of track record of what you do. Go back in time and analyze what you did because you can learn from yourself to become a better investor. That's one of my favorite things about this channel is it helps me improve. And one of the things I learned is if I ever feel like I need to deviate too much from my core, more conservative investing strategy, if I'm going like after high yielders or high growth stocks instead of kind of core, stable, steady dividend growth stocks, or now I'm mixing in some bonds as well, but I kind of lump that into a really conservative strategy. And I've been in bond-like investments for a very long time, the whole life insurance. But what I would say is that I kind of lump in with dividends. But if I see myself kind of getting too aggressive or going into too many different directions, it's a signal to me that I need to slow down and just put that money in cash. It's better in cash than going against my core strategy. And so that was a big lesson learned for me that has been incorporated into my strategy now. And that's why I want to go aggressive buying as the correction happens here. This correction may last for quite some time, but when things start looking up again, when things start getting to reasonable values or overvalued again, that's going to be a time when I'm going to slow down and just kind of put money in cash. And so that's where I'm at right now. And put in the comments below, have you done analysis like that on yourself? Have you seen yourself in the past make mistakes and learn from them? I've been in this over 20 years and I keep making mistakes. I keep learning and it's all there for everyone to see on YouTube. But I want to share right now the stocks I'm buying right now. So as you can see on the screen in front of you, I want to share a spreadsheet here that just shows I'm buying quality that can withstand any storm. And so I am buying 4 core stocks right now. My patrons see all of these trades on the backyard level and the corner level. I'm buying Johnson & Johnson right now. It's not a screaming value, but honestly, those forward PEs look pretty nice in the 16s and 15s. And this is a stock, a company that will weather any storm. Payout ratio is low. There's room to increase that dividend. Starting yield is okay at 2.6%, but the compound annual growth rate is nice at 6.1%. So Johnson & Johnson, I've been buying. It's my largest holding. It's quite large in my portfolio. Whereas it's not a value right now for strategic reasons, I'm buying PepsiCo. My patrons already know this, but Starbucks is now the number 2 largest position in my portfolio behind J&J. So I'm strategically, and I did that for reasons of valuation. Starbucks is at a great value, so I added to it pretty aggressively in recent weeks. However, what I would say now is PepsiCo falls down a notch in the portfolio, but eventually I want PepsiCo to be larger than Starbucks. So strategically speaking, whereas it's kind of expensive at the PEs it's at, I guess for Pepsi those are reasonable PEs. But I want to go ahead and continue to buy more Pepsi. And I love the 5-year CAGR, compound annual average growth rate. The average growth rate of the dividend per year is 7.4% on PepsiCo. But out of the bunch of stocks I'm mentioning today, this is the most expensive one. That's why I went for Starbucks first, just to kind of get that, because it's at more value levels for Starbucks, given their growth rate, in my humble opinion. But now I'm kind of going back to Pepsi to build that up and bring that back into that second position in the portfolio. By the way, I want to give a shout out to my friend Russ. I'll link to him in the pinned comment below. Russ is from Dapper Dividends, and he just did a video on how he bought 100 shares of PepsiCo over the course of 100 weeks, 1 share per week, and it shows the dedication and the power of that slow, steady, brick-by-brick strategy. Congratulations, Russ, on your huge accomplishment, and thank you for allowing me to do a little intro in that video. I really appreciate that, Russ. It was really fun. And everyone check out Russ in the pinned comment below. But as you can see on the screen in front of you right now, the next stock I'm buying right now is the Home Depot. I cannot pass this thing up at a forward PE of in the 16s and 17s. J&J's PE is at the same level, but J&J honestly is at that level because they have litigation risk. Home Depot doesn't really have any litigation risk that I know of at this time, and the PE that it's at, given how quickly they're growing, given that their 5-year compound annual growth rate is 16+% per year on the dividend. I love Home Depot at these levels. I've already bought a ton of Home Depot. I'm going to continue to buy more. I'm also buying Raytheon Technologies with a forward 2023 PE in the 15s, this year forward PE in the 18s. I love the 2-year CAGR of 7.6%. I only have 2 years of data because it's a newly formed company in many ways after it spun off its entities of Carrier and Otis, which I also own, but I love those 4 stocks. Now, what's also on the list is McDonald's, trading at a starting yield of 2.41%. I recently added some of that as well. 3M is on the list as well. I recently added a lot of that. It's at a 4% starting dividend yield. Apple is on the list at a 0.67% starting yield. Starbucks as well at the 2.72, but the reason I list Starbucks last is just strategically speaking, it is large enough in my portfolio right now. I would also like to say Treasury notes and bonds are on the list. The 20-year auction I just participated in a major way, and I locked in some nice yields. I'm going to go over that in a minute. All right, everyone. So I want to close out the video today with a quick segment on Treasury bonds because some of my subscribers were asking. Thank you for hanging in there, by the way, in the video today. I know there's some background noise, and I've had to, here in filming, start and stop a little bit. And so I'm doing my best here. We're in the final stages of our move and everything, so just trying to make it through. Get everything 100%, all of those loose ends closed out. And so thank you everyone for hanging in there through the video. It's a little bit choppier today, I know. And so I appreciate your support. As you can see on the screen in front of you right now, this is a recent Treasury news update from the recent 20-year bond auction that happened earlier this week on May 18th. These bonds are actually going to be issued on May 31st. I participated in the auction. I have all my funds lined up. I'm doing this through Treasury Direct. I'm going to do a whole separate video on this, but I want to give a little bit of a preview to show you these interest rates. These bonds are really cool because they are exempt from state income tax. They are only you only pay federal income tax on them. And the interest rate, the face value coupon interest rate for the 20-year bond was the highest print I've seen on one of these auctions as of late. It was 3.25%. The high yield was 3.29%. On Treasury Direct, you're just a passive indirect bidder, and so you kind of take what the market gives you, but there's people actively bidding in these auctions, high rollers, sovereign nations, financial institutions, banks, so on and so forth. But what's interesting here is you see the price, and the price is $99.41.6025, and so you get the $100 face value on these things, but you're paying $99.41 for that, and so that's pretty cool, and that gives you actually an implied interest rate that's a little bit higher on cost than the 3.25, and it shows the median yield, low yield, so on and so forth. I'm going to go through more of this in the future. I'm still kind of learning. I've been through a few of these auctions so far, and each time I've gone through one of these auctions, the amount of money that's being extracted to pay for these bonds is less than the face value that they have when they mature. So you get that kind of bonus there, and interest rates are high, and I'm seeing high interest rates across the board on all of the auctions, on the notes, on the bonds as well, shorter term maturities, longer term maturities. It's pretty interesting, but as you can see on the screen in front of you right now, I wanted just to show, you can see a little summary here on the right hand side towards the middle of the screen, the 20-year 518 auction. Again, the price was $99.42. So if I take the annual cash flow of $3.25 per $99.42 invested, and I divide 325 into 99.42, I get a yield on that price of 3.27. So it's a little higher than the 3.25 coupon kind of face value interest rate. And I want to share at a high level. I don't want to get into too much detail today, but I had some folks in the comments speak down about this. They're like, Ian, but you're losing 9%, 10% to inflation, what's the point of buying these bonds? Well, I'll tell you the point of buying the bonds is if inflation is high, but stocks are going down 5 or 10% in a single day, certainly a 3.25% annual interest paid semi-annually plays a role in the portfolio during volatile times. The other thing I like about Treasury notes and bills is it helps me partition out funds for future deployment. I've got some capital. I don't want to deploy it all right now. I think this bear market could last for some time. I can put it in some notes and some bonds, and when they mature in future years, I can make the decision at that time, hey, do I want to deploy it in dividend stocks at that time? Do I want to keep it in cash? Do I want to use it to pay for retirement? Do I want to put it into bonds again? There are options, and so it's a great way to partition out money. But I think this argument that, hey, you're losing money in bonds, well, I guess that's true in some ways because it's losing to inflation, but not necessarily if you have fixed expenses like myself. I have a fixed mortgage, for example, and if I can invest in bonds that are at a higher interest rate than the mortgage rate, there's some arbitrage there as well to be had. And so that's another way of looking at it. Now, after tax, it's harder to have that arbitrage. And do I really have the arbitrage? Maybe yes, maybe no. But what I would say is having the money in the bonds versus paying down the mortgage, a benefit of that is just providing myself more liquidity, more options in life, my family, myself, more liquidity, more options. And so these are some ways I look about it. I don't think there's one right way, one wrong way to look at the situation with the bonds. But for me, during volatile times, they play a role in reducing the volatility in the portfolio. They provide a way to partition out money for future years, so I don't have to deal with it now. I can just earmark it for future and determine at that time whether it goes into stocks or into bonds. Again, it protects the money. Treasuries are backed by the U.S. government. I don't think that the government will default on treasuries. And last but not least, the yields are spiking. They are spiking to levels we have not seen since 5 years ago. Now, they might spike more, and so there may be a further buying opportunity in these bonds, but I like buying an asset when it's out of favor, and right now bonds are out of favor, and they play a role in a conservative income-oriented portfolio, and I can use that income to pay bills just like the dividends. And again, for me, being in my 40s now, 20-year bond puts me in my 60s. And so, it could be that it matures just at that right time for kind of those classical retirement years as well. And maybe it's a way just to supplement dividend income as well, or provide extra liquidity so that dividend stocks never need to be sold. Because one thing I think about quite a bit, especially during these types of market cycles, especially when there's possible layoffs happening, one of the most important strategies as a dividend investor is safeguarding the dividend stocks. It's just about holding on to those assets, making it through the market cycle. So let me know, everyone, what you think in the comments below. And if you enjoyed the video today, please go ahead and smash the like button. It means the world to me. Please also go ahead and subscribe. Before I go today, in terms of a friendly disclosure, I own the stocks mentioned today. I'm long Chubb, ticker CB. I am long Raytheon Technologies, RTX, Otis, ticker OTIS, Carrier, ticker CARR. I am also long Johnson & Johnson, ticker J&J, Home Depot, ticker HD, PepsiCo, ticker PEP, and I am also long McDonald's, MCD, 3M, ticker MMM, Apple, AAPL, and Starbucks, ticker SBUX. I am long all those stocks in my personal dividend stock portfolio. Also, I'm long Treasury bonds. In terms of a friendly disclaimer, today's video, it's not investment advice. I'm not a licensed investment advisor. Today's video, it's just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed financial advisor first. I'm just sharing my journey here on YouTube for fun and entertainment. It's possible to lose money in the stock market, in the financial markets. As we've seen lately, it's quite volatile. So please consult your licensed advisor before making any moves. I'm just sharing my journey for fun and entertainment. I love you all. I'll see you in the comments below, and I'll see you in the next video.